There are two very big stock opportunities right now because the CPI data is positive. Now, these two opportunities I think will be gone very quickly, but right now I think there's a very good chance that when we invest in it, it's extremely safe and high potential. Now, what are these two? These two stock opportunities are driven because CPI, Consumer Price Index, was shown to be positive. What do I mean by positive? I'll explain in a moment. This will drive very, very likely for the Feds to cut interest rate. And because of the cut interest rate, let's think through which are the two sectors that will benefit greatly. So right now, there's an opportunity, and let me go into it. So CPI 2.9 and 3% versus expectation. So in fact, it is in line with expectation because if you look at the expectation of CPI, we expected inflation to be 0.2 and also year on year to be 3. So it's slightly below expectation, which is a good news because people are really expecting inflation to drop slightly. And now, not only it hits expectation, it is slightly lower than expected. So what this means is they expect the Fed to cut interest rate. However, I need to explain something that's very important. We can see that this expectation has already been there. So the rise in stock market has already priced in the idea that interest rate may be cut. Now, what it means is in September, we know that when the Fed they may announce that interest rate is going to be cut. Don't always expect the stock market to like roar up and shoot up. Why? Because they may cut lesser than expected. Do you expect the Fed to cut it by 0.5 points or maybe just 0.25? So you must understand, expectation is one key thing. Now, the thing is this, I look at what the opportunity is. We know that the CPI mostly is driven by housing costs. Now, here is the big clue. Housing costs, it's still slightly on the high end. However, it's easing already. Think about it. When interest rate drops, which is the sector that is most likely to benefit? If interest rate is cut by, let's say, significantly half or even more the next few months or the next few years, which sector will you be most interested in? Now, let me share with you. This is the forecasted based on probability. Forecast the target rate to be cutting all the way for the next few quarters from 18th of September all the way to 2025. Now, the idea that I'm going to share with you, right, may not be an immediate spike in price, but given time, this should play out well. So what are the two key ideas? Now, the key idea is this. You see, for S&P 500, they has been going up since the COVID period. They have recovered, reached a new high, went into like a slightly bear market below SMA 200, and then they reached another new high. There are two key sectors that didn't reach the same new high as S&P 500 because they were affected by the high interest rate, which are the two key sectors. The first key sector, which is opportunity number one, is this, the real estate sectors. Okay, so this is XLRE, which is the real estate ETF by SPDR. You can see that after the new high, they went all the way down and they have not recovered. Recently, they crossed above SMA 200, simple moving average 200. So I expect them to at least reach back the new high of 2022 and beyond with interest rate cuts. Does it make sense? Will you like be more interested to purchase a new house and take on a home loan when the interest rate is lower? I mean, most people will. Some people, they may be waiting for this time. Some people, they may be refinancing, but there will be a lot more movement in the real estate sector. So this is one particular sector that I will add into my portfolio. And I believe that, well, even if it doesn't shoot all the way up, there's a very little downside in my opinion. Now, the second sector is this. It's not really a sector per se, but it's a small caps company. The Russia 2000 is made of small caps company, and recently they already spiked up for a very simple reason. When they spiked up is because when they talk about possible interest rate cut, that's where a lot of investors, a lot of institution money start to think that we should start to focus back on the small caps. Small caps actually form a very big base of the whole entire economy. And when interest rate drops, it means that small companies, smaller companies, I would say SMEs, they are able to borrow more money at a cheaper rate. They don't have to pay so much interest. They can start to do expansions. So this is one possible idea. And Russia 2000, well, it has been typically quite a good investment, but for years, since 2021, after the COVID recovery, it has been ranging sideways and it has not even recovered to the new high. In fact, recently it dropped again to near the SMA 200. So this is a quick video. Wanted to quickly update all of you guys. Do comment below what you think and which other sectors can be positively affected, okay, positively influenced, okay, with a cut in interest rate. So let's really gather more ideas on this and start to accumulate some of these ideas. Now, in September, again, historically, it is a down month. So don't expect the Fed to announce cut in interest rate and the market shoot up. Well, there's a 50-50, I think. There's a 50-50. But the whole key thing is this. I'd rather buy into sectors that I know will actually benefit, not just based on initial market rush, based on initial expectation. So these are the two key ideas. Now, as per every single video, I want to remind you, size is nothing, sizing is everything. What it means is, no matter what your portfolio is, now this is very important. I know you want to skip the last part, but always drill this in your mind, that position sizing is everything. So the two opportunities: don't sell your house to buy the real estate ETF. this quite funny, okay? Because if you sell your house, you're selling to someone and it helps the economy, I mean, in terms of the housing market. But the whole key idea is this: sizing is everything. Make sure you position size, regardless where you're investing in. Make sure that you can afford to, in event the theory it does not go according to what we think, we can still afford the whole hit and the whole loss. But in the long run, I guess everything will do well. I'll see you in the next video.